What I'm about to share with you will likely frustrate you as well as blow your mind, but it does challenge much of the conventional thinking in terms of why we, quote, invest in gold. Let's talk about it as we explore. Yes, invest is a term that is being used by this piece here that I'm going to be referencing by Lance Roberts about gold myths that are luring investors into risk. Now, I don't like that word investor with regards to gold because gold is not related to investments. It's about protection against economic instability, against growing debt, and against the debasement of our currency, all of which are being addressed in this piece. Now, my friends at Summit Metals, they know this all too well, about what's going on in the world. They have their own YouTube channel, but they have also a great company that will buy and sell your precious metals. So check them out by clicking on the link in the description below and experience the great customer service for yourself. Now, I do like to be challenged in terms of my thinking. I think iron sharpens iron in that regard, and I think it's good that we have a full understanding and grasp as to why we hold gold. Now, this article is in relation to gold, but it can be applied to silver as well to some extent. So this piece really does challenge kind of what's behind some of the reasons why we stack. Investors are quick to rationalize why this time is different. You've actually heard me use that phrase too with regards to the bull run. In stocks, it's about artificial intelligence and data centers. The cryptocurrency community believes all fiat currencies will fail and everything will move to digital assets. But when it comes to gold, the voices have grown loudly, claiming the reasons for the rise are debasement of the dollar, de-dollarization, and soaring debt levels. That's right. And even Bloomberg has kind of summed it up with some of the worries about threats posed by runaway budget deficits, and those who believe in it are pulling away from sovereign debt and the currencies they are denominated in, and in the process fan inflation by continuing to crank out cash, is the highlights of that piece. And he says that the problem with it is that it was unresearched and just recycling of already prevalent myths. And he wants to go through and address each of these myths. There's 3 of them, and let's see if we can make sense of them. I agree with some of what he says here, but I think there's more to it than that, and I think we need to think about and really challenge our unconventional way of thinking on this. And there's a lot of this has been repeated across media outlets and in investor circles, and I certainly have seen that. And a lot of the stuff, a lot of the mantra, the reasons why we do it, I think the reason is because it is well-researched and well-grounded. But nonetheless, and he says that some of the myths about central banks are hoarding gold to get out of dollars, and to suggest that the global financial system is rapidly moving away from the U.S. dollar. Now, central banks have crossed a symbolic line of their combined gold reserves to now exceed their U.S. Treasury holdings for the first time in nearly 3 decades. And it references some data that was published, but it was really referencing price differences. Bond prices have declined in recent years as rates have risen, and gold prices have increased. However, what Statista wants you to believe is that this represents a significant change by central banks to buying gold and selling treasuries, which in reality is not the case, the author says. But the actual change in gold is a percentage of foreign reserves has primarily been a function of price increase. Over the past 5 years, central banks have only increased the amount of gold they own by roughly 5%. In other words, they have not switched significantly to buying gold. Well, I disagree with that. They have. You've looked at the numbers. No, I don't know 5% is the case, but many of these countries have been adding like crazy since 2022, to the tune of over 1,000 tons per year. That's a big deal of central bank holding. Now, 5% is pretty big because they've made a notable difference in moving in that case. But nonetheless, they have been not selling treasuries to get out of U.S. dollars, he goes on to say. Instead, they have been adding to gold holdings as the prices increased. Well, that move alone means that instead of buying dollars or treasuries, they're buying gold. that alone is de-dollarization. So, but it is not a rapid incline, and I agree with the author on that. But he says that they have also bought Treasury bonds in record amounts, with foreign holdings now exceeding $9 trillion. And some of that is the case, but whenever you buy gold, you are, in a sense, that act alone means that you're choosing one asset before another. And remember, in April of 2019, the Bank of International Settlements, which is the central bank of central bankers, has relegated gold to be a tier 1 asset. That's what they have made it to be, equal to and on par with cold hard cash, including the dollar, by the way. And I think that was a precipice for some of the movement in that direction. And remember, the United States has not sold a single ounce in recent years, or added a single ounce to their 8,133 tons of gold. And he says the reality is that while central banks have accumulated some gold over the past 5 years, it isn't a function of fleeing the dollar. Instead, they are rebalancing the reserves. Adding gold is a form of diversification. That's true, but that is a form of de-dollarization. Whether you like it or not, it is. But you're right, they're not fleeing the dollar, in a panic or anything like that. It's not in their best interest. And of course, it would probably hurt them more than help them. And they know that. And I agree with that sentiment. Particularly adding the gold as a form of diversification, particularly if the dollar is weaker than their own currency, not as a replacement. And in a recent survey by the World Gold Council, only a minority of central banks said they plan to reduce their U.S. dollar exposure, and even fewer intend to sell U.S. treasuries. But they're pretty big countries that are doing it. There may be a minority of countries that are doing it, but they're big. They're countries that are a big deal. Mainly in the BRICS group. Most still see the dollar as the most liquid and stable reserve currency globally, and that is true. The interest in gold is more about risk management than ideology, and I agree with that on some level. But ideology plays a huge role, which is why many of these nations, especially the BRICS nations, are doing it. Ideology is absolutely paramount in this. There are other practical constraints. Gold is hard to store, expensive to transport, and doesn't pay interest. Furthermore, gold offers no yield, so that it depends solely on the price changes to protect their preserved balances when holding the asset. Well, the thing is most of that infrastructure is already in place. They have the place to store it. They have the security there. That's not really a big deal. Most critically, central banks can't swap extensive holdings of U.S. treasuries for gold without triggering a liquidity crisis in global markets. While there has been a modest increase for the demand for gold, actually it's been more than modest, I would say. I think that in most reasonable analysts would say there's been more than a modest increase in demand. Mostly from speculators, it is incremental with respect to central banks and is not signaling the collapse of the dollar system. You're right, it is not signaling the collapse of the dollar system, but it has been a pretty big increase in demand from central banks, and that's what has buoyed up gold's price. History supports this. Even during the Cold War, when the ideological lines were clear and distrust in Western systems was high, countries didn't entirely abandon the dollar. Gold served as a partial hedge, not a full replacement. Well, that's because we were siloed. In other words, it was the Soviet Union and its satellites against pretty much the whole world. I mean, China, notwithstanding, was not nearly as advanced as they are today. So essentially, it was the West versus the everybody else. It was not nearly as much competition as there was today. And today's environment is no different, but it is different. It's completely different than it was back then. So I wholly reject that aspect. Just looking at just basic history, is you can tell that. Anyway, central banks aren't dumping dollars. They manage risk across a broader portfolio. Now, that statement I agree with. Now, the second myth, the death of the dollar and fiat currencies is here. Now, that is something that is true. That is a myth. The claim that fiat currencies are on the verge of collapse and that the dollar is finished is primarily ideological. Amen. I 100% agree with him on that, and I like to be as intellectually honest as I can about that. The dollar is not going away anytime soon. It's popular with hard money advocates and gold bugs, but this gold myth has no historical or institutional basis. That's true, but remember, even though this is not going to die anytime soon, the fact is it is dying, but it's dying a slow and painful death. and that pain is being experienced by us because of inflation. So yes, the dollar is not going to die anytime soon, but it is dying. First of all fiat currencies don't die in a day. That's true. Legal system, state power, military force, tax policy, and institutional trust underpin them. If the dollar were truly being debased, you'd see a very different set of outcomes. Instead, we see the opposite of a capital fleeing U.S. assets, a collapse of U.S. Treasury demand, and a breakdown of global trade settled in dollars. The dollar remains the default unit for global trade, cross-border settlements, debt issuance, and central bank reserves. Treasury demand remains robust, and the dollar is still used in 80% of global transactions and represents nearly 60% of international reserves. And I think that number is around 57.5% or somewhere thereabouts. But it is declining. It has been less and less of international reserves than it has been in the past. The 80% of global transactions, that sounds about right, but likely that probably number is inflated as well. Central banks, sovereign wealth funds, and institutional investors continue to hold and accumulate U.S. assets. So while media pundits scream about a loss of trust, global capital continues to support the dollar. When people say the dollar is dying, they often conflate two things. First, they mistake a decline in purchasing power for systemic collapse. Inflation erodes the value of money, but it doesn't mean the monetary system is failing. That's true. Yes, if you have held dollars in a coffee can since 1960, you have certainly lost purchasing power due to inflation over time. That is because the economy has grown sharply since then, leading to high standards of living. However, this is why we invest dollars into assets that consistently produce above inflation rates of return. And that's true too, and that's why we hold gold, not necessarily to invest, but to protect against a dying dollar. And that's why we hold it, for sure. And they assume that any new currency alternative, whether gold or yuan or digital asset, will instantly replace fiat. The Japanese yen and British pound have gained exposure to foreign exchange reserves in recent years, along with the yuan, whose economies have prospered. However, they still only make up a minor share of the total. The dollar is a dominant currency, is what they're saying there, and I agree with that. But nonetheless, it does not mean that the dollar is not dying. The dollar is dying in purchasing power, and honestly, in influence too. It may be a slow degradation, but it is there. De-dollarization is real, folks. The third, the gold is surging due to debt and increased money supply. Now, this one is very controversial. This narrative gets traction every time gold moves higher. Commentators argue that rising U.S. debt levels and persistent budget deficits erode confidence in the financial system, prompting investors to seek refuge in gold. This argument is straightforward. More debt equals more risk, resulting in increased gold demand. The problem remains the same as with all other myths. The data doesn't support it, he says. Gold prices are not directly tied to government debt levels. If they were, gold would have surged in the 80s and 90s when the debt to GDP ratios climbed steadily. Instead, gold stagnated for nearly 2 decades. The connection is more nuanced. Gold tends to respond to changes in interest rates, inflation-adjusted returns, and perceived instability. In other words, emotion, and not debt ratios in isolation. And he goes on to talk about that, and he shows some charts here that are incomplete as far as their data are concerned. So, like for instance, the debt to GDP, the M2 to GDP, the M2 money supply. He talks about the M2 money supply not being really that bad compared to the economic growth. We're seeing economic growth, and I can understand that mode of thinking. We need more money to meet the needs of the economy, more of these dollar bills. But the problem is we have way too much of it. Way too much of it, and a lot of it has not come back to the U.S. A lot of it is floating around the world to meet some of those transactional demands, but also just in terms of its value proposition, what have you. So the M2 money supply compared to the amount of gold, it is way out of hand. The debt is way out of hand. The deficit spending is out of hand. He doesn't talk about government spending here. And yes, you can have GDP that grows, but the people lose faith in the dollar, and they are starting to. That creates a real problem, and that's one of the reasons why gold has gone up. And of course, There are circumstances and situations now that are being bolstered by geopolitics and other areas. But what is the foundation of it? The foundation of it is a growing debt, is growing deficit spending, and an increase into money supply. And that causes inflation. That is what inflation is. And inflation, though it's scaling back some, it is still there in full force, stubbornly sticking with us at 3%. So I like to be challenged, and this is an interesting article indeed. But I think it's misguided. I'll say that, and on some of the points that they give there. Let me know what your thoughts are in the comment section down below. Hope you found this video informative, insightful, and educational. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.